Want to welcome on my guest, Todd Sohn from Strategist. Todd, good to hear from you, my friend, and thanks again for coming on the show. We appreciate it.
Thanks for having me, Dave. I appreciate it as well.
So you took the time to send a couple charts ahead of time. I really appreciate it. And talking about volatility, which is great because this has come up on the show a couple times in the last week or so. So I'd love for you to walk through your charts about low vol environments and what they mean. So the first chart, we're looking at the last 10 years or so. What are you seeing here?
Yeah, so for as much headline volatility we've had in the news, given the trade war or endless amounts of issues, right? Equity market volatility is actually in a historical extreme going back about 40 years. What the bottom panel here shows you is the average daily range on the S&P 500 over the last 20 days. So that's at about 54 basis points. And I think the most important part of this is that low volatility environments are associated with new cyclical upswings and a bull market, right? The most recent example being 2017. But even on this chart, you can go back to, say, 2013 or 2014. So as boring as the tape may be right now, we need to use this to our advantage that we are in a fresh leg higher.
It's really interesting, and it's funny. I find a lot of sort of novice users thinking about, the VIX, thinking about volatility, for example. At a low level, you immediately think that means it has to reverse up. But what you're showing here in 2017, for example, it was low and it stayed low for quite a while. Now, how does that compare to what you saw in the mid-90s? This is the second or early 90s. This is the second chart you sent us.
Yeah. So outside of your 1 or 2 day setbacks, these environments persist. And if we wanted to go back further in history, like we have here, look at the early to mid-90s, volatility decreasing as the early part of that decade went on. You started to hit those extremes in the 5th percentile of our observations in our database. And when you hit that, it's a signal that things are pretty good. The trend is well in firm hands, and that don't be too scared if you get these modest setbacks where you have, say, a VIX blow up on a 1 or 2 day period. That the broader market is still very firm. History is very much on our side here.
It's really interesting. Now, again, a lot of the conversation we've had with some of our guests recently is thinking about the U.S. versus global equities, how to relate the two of them together. Your third chart is dealing with ACWI, the All Country World Index. What are you seeing here in terms of where it's at relative to some key levels?
Yeah, so as we have this low vol environment, you may get a small setback, and I think this is a logical place that you have the ACWI, right? All global stocks right back to the January 2018 highs. Could you get a small setback? Of course, but I think what the big difference is in 2018 versus 2019 is that it's not just the US. You have markets like Japan and Europe and portions of EM actually rising here, whereas last year, as we all know, in the fourth quarter, it was just the US going up. Well, you had a global equity bear market. So I think this is an important chart to watch in terms of levels. If you get the ACWI back to, say, $75, I'm more inclined to be buying that dip, and then eventually the market responds and you finally break over that 2018 high. It's tough for me not to see this as a new bullish upswing for global equities in terms of participation.
It's a really, really interesting long-term chart. And I love the long-term perspective here. It's, we always coach people. It's so easy to get caught up in the short-term movements. Here you're given a great long-term picture. I'm very curious with this last chart, looking at All Country World. If you're thinking a pullback makes sense because of resistance, thinking it would be buyable if it gets down to 75. What does that mean about the U.S. versus global markets? Is that a signal to tilt more internationally than you would have otherwise? Is there some way that you would look at U.S. versus non-U.S. and make that call between the two? How do you think about, or how are you coaching your clients to think about that?
It is on my radar. I wonder if it's a little premature to say that U.S. will give up leadership.
Right.
But at the very least, I have more to allocate to now. If I have X amount of dollars, I can move some of that out of the U.S. now and into Europe and Japan and EM, and it'll be treated much better than it has been over the last, say, 18 months. I feel much more comfortable with that. The relative performance, though, is, I think, a question mark going forward. That's the more difficult question, if the U.S. will ever actually give up this great leadership it's been.
Right. Now, going back to your first chart, just to wrap up, and thanks again. These are three really interesting charts. The very first one, looking at the S&P 500, obviously you're sort of talking through a pretty constructive take on equities. Looks like this sort of pattern traditionally has led to stronger stocks. That's pretty decent. What would you see on this chart that would tell you that maybe that's not playing out? Is there some sort of key level or some signal for the S&P 500 that would tell you, okay, it's not going up anymore, this is a chance to get more defensive? Is there any particular line in the sand or signal that you'd be looking for here?
If you can't hold the 3,000 area, then I start to get a little worried. And I would also emphasize looking internally, right? We've had some signs of a cyclical rally here where industrials and banks have been leading. If those roll over again and we're back to the environment we were had for the last year and a half, then I get very nervous. And if you start to see staples and utilities and REITs catch a bid again, that would get me much more concerned, and I think would weigh on the S&P. And you're again back below 3,000. You're back into the range for most of the year. So keep that on guard, but also make sure you look at the components of what individual stock, how the individual stocks are actually acting.
That your last comment there, Todd, is fantastic, and I appreciate this. The idea of thinking about the big picture, but then there's no replacement for the bottom-up work to really think about leadership and what's working and what isn't. Todd, thanks so much for joining us. 3 really good charts and a really interesting take on the markets. Thanks for coming on the show, my friend.
My pleasure, Dave. Thanks a lot.